Good to see you all. Thank you for joining us today. Just want to kind of reinforce lots of the points that have already been made this afternoon anyway. I'm just going to talk about being ready for your exit and are you really fit for sale? Now, my colleagues are with me today, Alex Duffy, whose primary focus is in TMT, and Rob Krupa, who supports us from our accounts team and is involved with providing tax advice and R&D advice, etc., is with me this afternoon, so they'll be available as well. Now, just to kind of to move on, I'm going to talk about, are you really ready for sale? Are you fit for sale? Which kind of covers off some of the points that have already been mentioned this afternoon. And I think what we want to talk about here really is, if you're going to sell your business, what you really need to do is to understand what you're trying to achieve with the business anyway. So you would already have a documented strategic plan for the business, which of course in this sector we're talking about your development roadmap, etc. That's really important in terms of where you are, what you're doing with the business, and being very clear about where your strategy is heading, what your demographic is that you're focused at, where you are with the portfolio of games that you've got, and where you're seeking to head with the business. Now, obviously, what is really important, has been mentioned already this afternoon, is the financial information. And it's important, obviously, to be able to, during a sale process and ahead of a sale process, to ensure that you're already producing timely financial information. And Rob Krupa from the team is involved with clients in solving those issues and helping them to come up with the right key performance indicators for the business, so that you could genuinely monitor the business. Because what you want to be able to do as you're coming to the market and trying to sell your business is to demonstrate the strength of the business, and that's really important. Now, hopefully what you've got already is a good demographic in terms of your user base, and hopefully what you also have is a spread of titles and a portfolio spread across what you've already developed, and that's really important as well. So what I want you to do as you think about these things is, in a minute we'll show you a scorecard, and I want you to be thinking about scoring where you are anyway, so that you can work out where your weaknesses are, so you can start to work on those to make sure that you are genuinely fit for sale. So clearly what's important is growth. If you're not in growth mode, then we need to come back around some of the points that were made earlier in terms of why is it you want to sell. And obviously what's important here is growing the business and also being cash generative in terms of where you are. And we talked about already the development roadmap for the business. Where are you in that pipeline of developing the games? Where are you in rolling out the next versions of the games and the design elements to it and everything else that's going on? Now, what's really important to a buyer is the recurring revenues. Touched on, previous speaker mentioned obviously that you value a business potentially by a multiple of profits, but that's driven to a degree in your sector by a multiple of the revenues. The two should equate to each other one way or another, so you'd end up with a higher multiple of profits and a slightly lower multiple of revenues, but we can equate that in a few minutes' time. And obviously what's really important are all the things that were talked about a few moments ago in terms of your legal documentation. So we're talking about the intellectual property that you've generated, making sure that you do actually own it, in terms of freelancers, contracts, etc. Any inbound licenses, that those licenses are watertight as well, and just where you are then with your people, because that team is pretty crucial as well at the same time. And obviously what is important in terms of if you're actually looking to exit your business is going to be dealing with and having a strong second tier management that you have ready, and obviously the strength of your creative team in terms of being able to sell. Now, if you want to exit altogether, I guess what this comes back to is maybe you're only working 1 day a week in the business now. I have to say that would be nice at some stage. But that's important in terms of being able to demonstrate that you're no longer critical to the business in terms of the key driver and the key element of the business. So that's quite important as well. So what we can do with this is, if you look at your business and you think about each of those areas, what you can do is score yourself out of 1 to 5. And the 1 to 5, the intention is it does give you the option to go in the middle for some of them, but you really need to to think on a granular basis about each of the different areas and work out how ready you are to be able to sell your business. And that will give you the focus on where you need to work on to be ready. Now, if we think about exit options, today is the day that Deliveroo has gone to market. Perhaps not a huge amount to talk about there, bearing in mind that wasn't as successful as they'd hoped. I know they were hoping to sell for 8 billion and then they listed for 7 billion, and then the share price has fallen by 30% today, or 27% last time I looked before we started. So, and I appreciate you're not a Deliveroo business, but interesting. perhaps an IPO for some of you. But let's think about kind of what you can do, and we've started to talk about this already. Clearly, in terms of looking internally as to what you can do, it's possible for you to go down the route of a management buyout, and we'll talk about that in terms of the pros and cons in a moment. And obviously what you can do is some kind of equity release, and what I mean by that is de-risking, and you can control who the equity investor is that comes into your business, be that a high net worth individual to help you, perhaps an experienced gamer from the industry, an entrepreneur who's done it before and therefore can help you to get to the next level. So hence why I've called that internal. And then obviously you've got the external routes, which again the previous speaker hinted towards. So the primary route that most parties take is a trade sale. If you're confident and your second team are behind you in terms of where you want to go, private equity may be the route for you. And then obviously for some businesses, there's a fantastic opportunity to go down the route of an IPO, so a listing of the business. So let's just talk about the pros and cons of each of those just for a few moments. Let's think for the moment about a management buyout. The key thing here is it's straightforward. You wouldn't have to give the same level of warranties to your management team, because hopefully you've involved them in the running of the business, so they know about the business alongside you, and are intimately involved with the business. And what it can allow for you as well is a phased exit for you over a period of time. So all of that, I think, is very interesting, depending on kind of where you are with your energy levels, what you think the business can achieve, and whether actually you're at the point where you just want to kind of step back a bit, but stay involved and actually to pass it on to the guys that have helped you to build the business. Now, the downside to that obviously is if you're going to run a management buyout with a management team, it can distract you away from the business. And it's important to recognize that it may well be a distraction for the business, and therefore to kind of focus on the process, to appoint the right advisors to get involved with you, and to kind of to work through it. Now, price may be a restriction. We come back to the fact that obviously where we are at the moment with the huge growth, I think you've probably all seen the Ukie survey in terms of the 30% or 29 point something % growth that has been seen in the gaming industry in the last 12 months. Surprise, surprise, huge benefit from the pandemic. And where we are obviously with buyers, it's a frothy market at the moment. There's plenty of buyers out there, plenty of money coming towards the sector as well with that level of growth that's gone on. So you may find that price is restricted, so that can be one of the downsides. If the management team can't come to table with the right sums of money, the level of leverage that you may want, you may be able to put into the business. I know Barclays talked about 2.5 times as a multiple. You may be able to get more than that, but 2.5 times is a good kind of high street level of debt to come into the business. But you know, where does that get you to with the price? If you think the business is worth a lot more, you're going to take a long time to kind of to sell or to achieve a full exit for you. So the funding may well then limit the initial proceeds. So there are kind of pros and cons to a management buyout. So I'd just kind of encourage you to think carefully and to talk to an advisor if that's the route that you want to go down. Trade sale, you're going to get a higher price potentially than a management buyout. The likelihood is you will be able to exit, if not at completion, on a phased basis, perhaps over the next 18 months or 2 years, passing over all the key relationships to the extent that they're important, key advertisers, key content partners, etc., that you're working with. Premium price is possible, obviously, in a trade sale. The buyers that are out there at the moment, I guess the kind of the Take-Two scenario that was referred to a little bit earlier, yes, that was a competitive auction in terms of what happened, and I think a premium price was paid for that business, as everybody would acknowledge. But Codemasters was a great business, well placed, and I think that's quite interesting at this time. Now, what are the downsides? If we're comparing this to an MBO, you will have to provide full warranties because the third party doesn't know your business, and therefore you're going to have to kind of give all of these statements of fact about the business and make promises in terms of what the business has done in the past. There will be full due diligence, and I know the next little bit later on the lawyers are going to pick up again and talk about due diligence. The key thing with diligence is it can be a huge paper chase, not literal these days because we do it all through data rooms, but every kind of contractual scenario that the business has had, you're likely to have to kind of evidence that to kind of to show what the business has been involved with, and as a consequence of that, it's a very full process. And we mentioned earlier earnouts. An earnout is highly likely to be able to kind of reach your desired price, and that's an important part of the process, to understand your earnout, but to be satisfied with where you get to on your day one money. So that's important with a trade sale. Most of what we would get involved with are trade sales in terms of in this sector, or private equity acquiring as effectively the financial buyer. Now, IPO is an option for one or two businesses, and I know we've all kind of perhaps watched with open eyes at kind of what's happened with Roblox in terms of their float earlier in the year and the huge price that they've got for the business and kind of how well they've done. An IPO should yield you the highest price because effectively the shares are liquid. After you've sold the business, other people can buy and sell them, so the multiples are much higher. And that was the point that was being made by the previous speaker in terms of the difference that there is between a quoted buyer who knows what his multiple is because it's quoted on the market, and kind of what he's going to pay for a private business. And he's always going to pay less than his current multiple, so that's going to drive it, and that helps you to kind of to see where multiples go as well. What it gives you, of course, if you go down the route of floating onto the stock market, is access to capital markets, so therefore you can bring other capital in. And interestingly enough, a number of the quoted businesses are the ones that go out and actually make other acquisitions to build the portfolio, to build the talent base, to bring the right creative team in, etc. But what does come with an IPO is obviously the publicity. Some people love it, and you need to kind of get used to that because being open is a really important part of it. Downside is the huge cost that's involved. Downside is the market volatility. Delivery, perhaps a good example of that right now, and obviously the loss of privacy, because actually everything will be open to public scrutiny and you do need to disclose the right information to the market. So that's an important part of the process, and the whole kind of process of putting together your prospectus is all about verifying everything. So the diligence process, again, is pretty stringent in terms of that you're likely to go to. So what about valuation? The first thing I'd say, as I introduce this, is it's an art, not a science. I think that's pretty important for us to understand. So needless to say, there's three different ways to value a business. Traditional bricks and mortar businesses, it's, you know, you can look at a business and say, well, you're buying a balance sheet, it's the net assets, and what's the goodwill worth? And you have to try and find a way to calculate that. Now, that doesn't apply in this sector particularly. So what we're really looking at is this business something that you could deploy discounted cash flow? Well, if it's got strong recurring revenues, which are very predictable, then maybe. Larger businesses, perhaps you'll deploy that as part of what you're looking at. But predominantly in the sector, what you're going to use in the SME valuations is a revenue or a profits multiple. And that's a really important thing to remember here in terms of how your business is going to be valued. But let's just think about how it actually works in terms of what's the value of your business. There are two things to remember here. There's the value of the business, which effectively is the enterprise value, which we'll show you the calculation of here. And then there is what is the share value. So the value of the business is typically a multiple of those maintainable profits or the maintainable revenues. And that's what's really important here, recurring maintainable revenues. And the price is going to be on a debt-free, cash-free basis. So if you've got plenty of cash in the business, then arguably you can add that to the share price as you've made these initial calculations. And what we're looking at here is a multiple of revenues or profits. And the multiple we've chosen to kind of highlight here is actually a multiple of revenues, which we see in the marketplace currently is somewhere between 2 and 8 times, which interesting enough equates back to those multiples that were being talked about earlier for profits of somewhere between, I think the figures quoted were 8 to 20. I think I'd probably quote 7 to 25 in terms of where the market has been. And that gives you the enterprise value. That is the value of the business. And then what you need to do, obviously, is look at your balance sheet where you are with debt and with cash. And you do the debt-free, cash-free adjustment. And then that will bring you back to the share value. Now, what are the factors that drive that? The age of the business, that actually can be important in this sector. And how long you've been around, that comes back to the user base and the demographic spread that you've got. It comes back to the portfolio size in terms of the number of titles, games that you're out there with. Obviously, how often the users come and play those games, which comes back to the revenue. If you're going down the ad model, obviously, then, you know, who are your advertising supporters and how long have they been involved, and those strategic relationships. The location of the HQ, pandemic has perhaps affected this in a way that was unexpected, because now a lot of teams are working a lot more remotely than they would have done before. But bringing the team together was pretty important. And the ability to kind of find developers close to the HQ was an important part. Any previous acquisitions that you've done, the IP that you've acquired, that's important to be able to kind of to represent here. And if you've acquired strong IP, that's going to help you as well. and then obviously the annuity revenues. Now, coming towards the end of what we want to talk about today. So the thing to remember here is that if you're able to show that your business has got strong revenue, strong profits coming through now and into the future, and you have low risk within the business. Now, the area we were talking about as we started to scorecard your business is about looking at where the risks are and reducing those risks. And that's going to drive where you are with the multiple. Now, we've illustrated it here with this graph, just showing you in kind of 3 to 10 times and kind of what you need to do to be able to drive that forward. The key thing to remember is driving the value is driving up the revenues, and i.e. the profits, and then at the same time driving down the risk, and what that's going to do is drive up the share price. Now, the key risks to focus on, industry standards. Obviously, there's going to be a lot of talk about in-game advertising and obviously addiction to games as well, and all of those things have come out with government reports, etc. But the key thing here is your users, how they're involved with the business. Now, obviously, Roblox, they benefited hugely from the fact that users are actually building their own games, and so the model is quite different. The embedded IP is really important to get that right. As was alluded to by the previous speaker. Talent, have you got them tied in on the right basis? The last thing you want is your key talent, your key developers, to actually, if you haven't got EMIs in place or something to tie them in, they walk out. It's not what you want, is it? It's really important. The advertising revenue, if that's a key part of your model, that's important. How you've got it tied in, what periods you've got it tied in for. The strength of your financials and the fact that your financial reporting is regular is really important. And then obviously we need to just remember disaster recovery. It is an important factor. Arguably it's a strength in the sector, but it's important for us just to recognise that it's one of the areas of risk. Timing does matter. You need to remember that when a buyer comes to look at your business, he's buying the future. In a sense, he doesn't care about the past. The past, he's expecting to kind of be replicated into the future, but you need to show him that there's further growth to come. So timing does matter. Typical process, what does it look like? A typical process is going to take you somewhere between, depending on the time that you put into each of these areas, somewhere from that initial preparation to go to market, targeting who you're going to go to kind of to completing a deal, somewhere from sort of 6 to 9 months to be able to complete a transaction. What's the market activity like? We've mentioned this previously. It's a very strong M&A market at the moment. Tencent obviously have been very active in the sector, keywords as well. Since they did their fundraising, Playtrix as well, in terms of where they are, and Keyword have got great M&A appetite since their deals. We have got some deals listed here. These slides will be available for you later, and they just highlight key things. Now, recent IPOs, Roblox obviously don't think they're going to be out there looking for acquisitions as such, because they're such a strong business in themselves with their own metaverse. Let's use that phrase, I think, for them. With the developers in-house as well, in terms of the gamers developing the games. Very successful business. Raytica is important. AppLovin is also important. They're filed for their IPO as well. So there's some interesting things. So what are the key takeaways? Not Deliveroo, particularly bearing in mind their disappointing day to day. But come back to your score, do the score for yourself. You'll see this in the slides that we publish later. And don't forget, you're driving up your recurring revenue, driving down the risk. And who are we? Menzies? Well, we're a top 20 firm of chartered accountants. And within our corporate finance team, as well as a TMT specialist, who is Alex Duffy, others of us as well have got roles that we're involved with some of the gaming companies as well anyway, in terms of them with their fundraising and with their planning their exits. So that's our team. And that's Menzies. Thank you very much.